Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. Thank you for tuning in to our quick tip episode. Today, we are talking about determining an owner's financial benefit valuation. Really important. If you listened and watched my business algorithm episode, you would have seen or heard that you got to know your destination. And to get to your destination, you're going to be able to determine an owner's financial benefit valuation, because that is how we drive the metric of what your practice is worth to someone else. And so, it's so interesting. I've done a lot in this space, and I know who's really good at doing valuations out there, depending on the industry. And it's always good to have 3 different valuations. And the conservative one is usually the best foundation because it allows you to build on it. Now, let's say you're not ready to sell your practice for 15 years. I still want you to do this. This is an exercise that's going to allow you to understand, what do I need to do to get the price I want for this? So, hey, Brandon, I'm showing my EBITDA at $280,000 after I add back all of my owner's benefit. And again, your EBITDA is one of the things we're looking at. It's that earnings before taxes, depreciation, all that. You can look it up, interest, the whole bit. But one of the big parts of that is basically our owner's financial benefit valuation. This is where we see, because here's the deal. You come to me and you say, hey, Brandon, we're doing $500,000 net profit. I'm like, great. What else? You're like, what do you mean, what else? I'm like, are you getting any benefits from the company? Like, are there things that are, it's not that they're company expenses, but maybe they'll fall off. So yeah, I do a business dinner every month that would fall off. And maybe it's my car. I'm able to write a certain percentage of my car off. And all these things are important because they're add backs. And if I walked into a business and they said, look, we're doing $500,000 and there's another $100,000 a year in owner's direct benefit, like, wow, that's not bad. Now, some of you might be like, I want to be at $10 million EBITDA and whatever. Great. I hope you are. But I know some of you are smaller, and I don't want you to feel like this is just for the big practices. This is for everyone. So to determine an owner's financial benefit valuation, I'm going to give you 5-6 simple steps. You ready? So the first thing is, let's just calculate your net profit. I know, sounds really simple, but I want you to go in. I want you to look at your revenue, your expense, what's left over, and what that net is. Look at that net profit. Look at that net percentage. And I want you to make sure the next step is you identify the owner's salary. Now, here's the thing. It's really important for you to look at the owner's salary where you see, what I am taking as a salary, can I replace myself in this business doing the same thing for less money or more money? Because if you're underpaying yourself, then to be honest, that's going to affect your valuation later. So I'll give you an example. I had a clinician this was an occupational therapist that was looking to sell her company. And she probably works 32 hours a week, we'll say. And she took a minimum salary. At the time, it was like $45,000. And this was years ago. And I said, oh my gosh, why are you taking such a low owner salary? And she said, because I want to have enough cash flow. And I said, okay, but here's the deal. She's like, Brandon, I'm really profitable. I go, yeah, but how many people can you hire for $45,000 to do what you do? She's like, no one. I'm like, so that's going to come out of your net profit because that actually is going to penalize you in that sense. So the balance in owner's salary is we want a salary that is justifiable, that we can replace ourselves with market rates at that same amount. We don't want to underpay. We don't want to overpay. Why do we not want to overpay? Because if we overpay ourselves, we're most likely paying more in taxes. I'm just being honest with you. If we underpay, this is the problem. We're not going to be able to recruit someone to take our role in that. And when a owner comes in, they're going to say, I'm not going to work for $45,000. Like, this is bogus. So even that example of I've walked into like businesses for sale that say they average 85,000 net profit. But that 85,000 is the owner's salary. And that 85,000, there's functions that still need to be seen. So really, it's not a net profitable company. And so that is something to keep in mind because we want to take away what I call owner's salary and executive salary. So it's different, if that makes sense. So I take an executive salary as the role, and then I take draws, which are the net profit. Once we identify that owner's salary, we add owner's perks and benefits. What are those perks and benefits? Again, that could be maybe owners it's drawn up where you get 100% of your healthcare coverage. Maybe there's different things like that you add in. Maybe there's different benefits as an owner, and there's multiple owners that are treated that way in that class. Again, check with your HR attorney. This is not, you got to check your legal routes, but you get my point. Add discretionary expenses. That may be charitable donations. That may be personal expenses run through the business that are approved by your CPA. All of those things are really important. Then I want you to add non-reoccurring expenses. These can be things that just come up, one-time expenses like installation of equipment, unusual repairs, legal fees, etc. And then I want you to calculate that adjusted net profit. So for the sake of this exercise, let's take it this way. We've got a company and we're going to, for round numbers, say they have $500,000, 500,000 in net profit. The owner does not work in the business, let's say, other than the fact that checks the books, board member, whatever, and let's say they take $100,000 salary. Well, chances are maybe it's a $60,000 expense in real life. So maybe we put 40,000, so we're at 540. And then maybe there's another $100,000 in perks and benefits. So now we're at 640. Maybe there's another donations and now we're at 700. There's a world where that $500,000 net profit becomes a $700,000 EBITDA when we do an appropriate add back. And that's what this owner's valuation is you're doing add backs to calculate an adjusted net profit. Now, I want to be clear, when we do a valuation, the first thing you want to do is you want to come to an agreed upon EBITDA that both the buyer and the seller agree with. That is critical. Then you'll play the multiplier game. And this is just my opinion. But what happens is sometimes it's a moving game. It's like, well, you think your company is $1 million EBITDA and I think it's $500,000 EBITDA. Get to that middle ground of what we both feel is fair and reasonable, and then the rest will come together. But that's a critical fundamental foundation for you. So I think that it's really important that when we're determining our owner's financial benefit valuation, we're looking at the wages that we take on that are not work related, if that is part of your business, looking at also any added benefits that are run through the business. Sometimes people put kids on payroll and they have functions and tasks. And again, your CPA allows it. Really understanding how to optimize your owner's benefit is something that you should look at. One of the companies that I work with is a company called Econologics, and they help with that. I also have a CPA that helps with that. And looking at what is fair and reasonable, understanding the tax laws so that we play by the rules. Again, I'm scared of two things, lawyers and the IRS. I always want to fundamentally play by the rules. Anyone that says they don't pay taxes is going to be locked behind bars. I have red hair. I don't need to be in orange pinstripes. So again, you need to check with your authorities, your opinions. You need to run your company based on other people's knowledge bases and authority and reputation as well. So you have checks and balances. But these are things that can help you prepare a better bottom line for your business. Statistic: only 2% of business owners know the true value of their business. Yet 98% agree it's important for succession planning and financial security. And that came from Exit Planning Institute. That's crazy. 2% of business owners know their true value of their business. 2%. Blows my mind. But then 98% agree it's important for succession planning. Well, my statement is this. Why do we wait until we're a year out to sell our business? Why aren't we working on that now so that we have years of dedication and work and putting in that play? I think it's so important. So as we wind down this episode, I want to give you this quote. And again, Warren Buffett knows really well because this quote is so true. Valuation is not about what you think your business is worth. It's about what someone else is willing to pay for it. Again, valuation is not about what your business is worth. It's about what someone is willing to pay for it. And putting the financial data together so that you have that value proposition so that people can justify what they pay. Now, it doesn't mean they may pay more, they may pay less, but having this data is critical. So I want to thank you again for tuning in to this episode of the Private Practice Survival Guide podcast, Quick Tips. I am so grateful for each and every one of you. Together, we are thriving. Again, not just surviving. So if you like this episode, like it, comment, tune in for more, share it, spread it, watch it, whether you're on YouTube or anywhere else where podcasts are listened to, you can participate in our game. Thank you again for tuning in to the Private Practice Survival Guide. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you loved this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.